Hello and welcome to Crux Investor. We caught up earlier today with Trent Mell, who's the CEO of First Cobalt, TSX-V listed cobalt refiner and potential explorer. And if you want our thoughts and opinions on the conversation, the opportunity ahead of them, and indeed the company itself, you can find that at cruxinvestor.com/club, where you'll also find detailed company reports, commentary from experts from around the world on a variety of companies and commodities. There are training videos, there's summaries of other interviews that we've done to save you a little bit of time. And of course, there's a thriving community of investors sharing their thoughts and ideas with each other. So go there and join them at cruxinvestor.com/club. And of course, we'd love your feedback too. So do give us a like, leave your comments below. And of course, if you want to see what we talked about, take a look in the description below. Trent, how you doing?
Very well. Nice to see you, Matthew.
Good to have you on the show. First time we've met, first time we've spoken. So looking forward to this. In fact, we were meant to speak a long time ago, but here we are today. So that's fine. Where are you?
I am sitting in my office in downtown Toronto.
But only you, from what I hear.
Only me. Yeah. We're actually in a WeWork environment. So in this period that we're in, it's actually not an unsafe environment because we're running at about 5% capacity across this office.
Right, better an internet connection as well, I suspect. Good. Well, look, why don't we kick off? Give us that 1 minute overview of the business and I'll pick it up from there.
Sure. Cobalt's an essential ingredient in batteries and specifically in electric vehicles. So we started this company about 3.5 years ago, looking for cobalt for the EV revolution, as I like to call it. And 3.5 years later, we've effectively merged 4 companies into one to create a bit of scale. And our near-term catalysts involve cobalt refining. We got a refinery that's built and permitted that we can talk about. And then we've got some cobalt mineral assets. And all of this is in North America. So a little bit of a unique spin for a supply chain that's found elsewhere. You picked a really difficult time to get into cobalt, didn't you? I came in at a fantastic time, right? We were a proxy, one of 2 or 3 proxies for the commodity. And we had, it was wonderful. 2017, early 18 was great. And then, we promptly fell into a 2-year bear market, and from which we're just starting to come out now. So, fortunately got the team, got the assets, raised the money before the market went south. And we've been quiet for 24 months now, quiet at least on the market side, but pretty busy pushing our assets forward. Okay, fine. Well, we'll get into that in a second, but I'm always interested in what the management team behave like, what they're thinking, how they approach problems, how they solve problems. So it might be worth explaining 3.5 years ago what you actually set out to do on day one and why you've had to merge 4 companies together to kind of keep it on the road. That's actually a good question. And there have been, by necessity, a couple of pivots in our strategy. So when we started the company, candidly, this was a shell company, some Vancouver promoters who came together to Trent, look, we got a company and a name, some liquidity and some money. We just need people and assets, literally. And I was the first guy in the door and with an idea. Now they're long gone. We put together a team of operators that have all come out of bigger companies like myself. And initially we were focused on what we call the Canadian Cobalt Camp. So this is Canada's oldest hard rock mining district, mined mostly for silver, but a lot of cobalt. And we went looking, as we've done in the gold space, and I've done it in my career. You go to old underground high-grade deposits and try to see if you can reconceive of these things as larger open pit, low-grade, high-tonnage operations. And success, I think the success in the Cobalt Camp is still going to be underground high-grade. So we merged 3 companies together to consolidate a huge district, 100 square kilometers that we control, 50 fast-producing mines. But then we saw something, frankly, more attractive from a mineral exploration potential, and that was in Idaho. Idaho being one of the only places in the world you can get primary cobalt. So acquired U.S. Cobalt, got our hands on the Iron Creek project, which is the flagship mineral exploration deposit. But as cobalt started to turn south, drilling is expensive, and we doubled down on our efforts on our refinery in Canada. And that's paid off tremendously, partnership with Glencore. And that has been the focus for the last 2 years, with explorations coming back into favor. I think we'll be back at the drill by next summer.
Okay, so tell us about the US cobalt asset, if you don't mind, because I want to try and understand what's been going on there.
Yeah, when we looked around the world, so our head of exploration, Frank Santaguida, came out of First Quantum. He lived around the world, worked around the world. He lived in Zambia and worked in the Congo, which is where 2/3 of cobalt comes from today. And so we looked in the Congo. We spent the first 6 months of our existence visiting, negotiating assets. Just too hard. It's hard for the big guys, and it didn't make a lot of sense for our investors to expose ourselves to that risk. So thereafter, where do you find cobalt? Well, it's a byproduct. It's a byproduct of nickel and copper operations. So you can look in Chile, You can look in Australia. You can even look in parts of Sweden and the Czech Republic. We ended up coming right back into our own backyard. And cobalt is hard to find. It's hard to find in any meaningful tonnage operations, and it's usually an afterthought to your development decisions on nickel and copper. But Idaho, the world over, is particularly unique. So we've got a hydrothermal system in a sedimentary basin where you've got primary cobalt and the byproduct is copper. So the inverse of even what you would see in the DRC. Now these are not nearly as big as the Congolese plays, but this has been a deposit that had a bit of history. Hannah mining, Noranda mining, people had drilled it. We had 600 meters of adits. We had a historic resource. 95% of our drill holes were mineralized, maybe more, over big widths, 10, 20, 30 meters. And so with that kind of success rate, it was hard not to turn our sights on that. So we've been drilling it out. We got about 5 million tons indicated and inferred combined at some high grades, and we haven't seen the extent of it yet. So we stopped merely on account of a tough market, but we want to keep it going. I really think Idaho has got a unique role to play, not just in America, but for an ex-African supply of cobalt in the years ahead.
Yeah, Idaho is interesting. I mean, we've had Jervois mining on here, and they've obviously got their Idaho asset too. I mean, you guys had conversations about doing something together?
We not recently. On the previous management team, there was a unique, if unfortunate, trait of North American cobalt deposits is most of them have a lot of arsenic, and it creates a problem. And so under previous management, eCobalt had that issue, a permitted deposit. Where do I send my concentrate when you've got 13-15% arsenic or more? And we have the refinery, the only one on the continent that has the permits and the autoclave, and it would have been a good match. We've each taken different paths for strategic reasons, and so we've gone our separate ways. We're a little different for reasons we don't fully understand. Our deposit is not does not contain arsenic. We're in a pyrite hosted system for our cobalt, so it's unique, frankly, across the cobalt belt. But Jervois is located adjacent the old Blackbird mine, which was the one big American producer back probably going 40 years or so. But beginning of the 1900s, it started producing. So there is a history of mining there. I think what they're doing is interesting, and it's necessary. I think there's room for us and a lot more, frankly, just to supply American needs.
I mean, the only reason I ask is obviously they're ex-Glencore guys. You're partnering with Glencore. Just wondered if there's any chance of a conversation further down the line as a result of that.
You never know. I mean, I'm not married. I'm not here for a day job. I'm a shareholder. I'm here to create value. I see some opportunity here in the near term to get ourselves to cash flow. It won't surprise you to hear that I think my stock is tremendously undervalued. So I'd like to do, thank you. And it's been a tough couple of years. I've got shareholders that are waiting on some catalysts, and some of them are weeks away, a few of them are months away. So we're just so close. I'm gonna do something for my shareholders here. Thereafter, people want to do something bigger or get me out of the way, that's absolutely fine.
Okay. I think that'll be an interesting one to come back to when we speak next, I suspect. So you say you've had to adapt, you've had to be agile in your thinking because the market has changed, has not been kind to you after you started the business. Refining seems to be the current thought as to how the near-term revenue comes into the company. Spending money under the ground isn't. So, what was that conversation like? Because obviously it probably wasn't that way around when you first started to kick this thing off, right? Yeah,
the market wanted to see pounds on the ground back in the heyday of the cobalt market, and as that sold off, the drill. I mean, in Ontario, our all-in costs were under $100 a meter, but they were a fair bit more in Idaho, topography and whatnot. So, converting tons in a market that was frankly selling a cobalt plate didn't make a lot of sense. It was actually one of my big shareholders who said, "Trent, you got that refinery there. You should be looking at that." And so I'll give others credit. When we finally did turn our minds to that, there was a real opportunity. We've got an asset here that's got kind of $90 million US of historic investment. It's built, it's permitted, built small. And when you look at that landscape, it's a China story. It's 80% of refined cobalt sulfate that goes in the batteries is coming out of China. Thereafter, you're looking at Sumitomo in Japan, you're looking at Umicore in Finland, and that's it. And so when you look at the EV market growing, we're at 16% CAGR over the next 5 or 6 years, 7 years. That's nearly a tripling of the market. So for us to look at refining capabilities and how you're going to respond to those demands, particularly in EVs, because that's the dominant usage now for cobalt. We just started doing engineering studies, some net testing, and basically trying to replicate the Chinese model to get ourselves off the ground. And it's been quite successful, and we're getting close to a construction decision here.
Okay, but you're going to need to be able to feed it, and you're going to need to be able to make some money from it. And in the current climate, it's still not quite there yet. So that decision making is going to be hampered until that kind of price discovery comes back. So what do you do in the meantime? Do you just keep things ticking along? I mean, have you got enough cash to do that? I mean, where's your head at?
Yeah, no, we're actually in good shape. So the I would call it, North America call it a V8 moment for us. Was, where do you get the feed, right? We got this refinery sitting in Canada, we're across the border from Michigan and all the U.S. Auto plants, and there is no North American cobalt refining to speak of. It's the byproduct out of Sudbury and Boise's Bay. But what do you do with this facility? And so you look at, well, what's Umicore in Finland doing? What are the Chinese doing? It's the same playbook. You're taking cobalt hydroxide out of the DRC and you're processing that. Why? Because within country, this is the African copper belt. You're making the copper cathodes in the country, selling it to market. But in part through the Belt and Road policies of China, the cobalt hydroxide is not beneficiated. It's it's a semi-finished good, but it's refined out of country, and all that infrastructure has been set up in China. So it kind of paves the way for a market that's virtually 100% exported. And so for us, it was, let's just take a play out of that book. We've got a trade war going on. We've got concerns over localization of supply chains, only magnified with COVID. The conversations with OEMs underline that. And so for us, it's, let's do like the Chinese and bring it here to this side of the world where we can service Europe in the short term more competitively, and then eventually be the only one here on the continent. Now, to your point, Matthew, about pricing, you're buying the feed based on a fast markets quote. Payability of the prevailing metal price is the cost of your input. And so on the downside, you do have some margin protections there. You're not fully exposed. Likewise, perhaps you're capped a bit on the upside as well. But for a startup, the feed is there. I got to say the interest is quite strong in all the producers to try to send product ex-China, again, for diversity. So we're in good shape. So we're not slowing down, quite the opposite. I think you're going to see some announcements from us here in the next 2 or 3 months, and even in the next few weeks in terms of how we move ourselves to a construction point in early next summer.
Okay, so just be clear with me, the feed is coming from where?
Yeah, the feed will be coming from the DRC. And initially, let me explain that a bit, the commercial strategy that we entered into. So we got our hands on some feed from the Congo, did some metallurgical and bench scale net testing, and lo and behold, I mean, this is beautiful material. It leaches really, really well. And ours is a hydrometallurgical plant. So it's a leach solvent extraction, and then you crystallize the cobalt into this pink powder, the chemical form that goes into a battery. There's no better product on the planet, and that's where most of the product is coming from. So I went to Shanghai about a year and a half ago to a big metals conference, cobalt conference, and met with all the big players. And these are big players. They were talking Glencore and ERG and China Moly and some of the big refiners. And so we're the minnow here in the big ocean, and just really happy with the tenor of conversation. And so we engaged in a bunch of conversations, and we initially landed on a strategic relationship with Glencore where we were going to be exclusive to them. We would toll treat, they would provide the feed, they'd market the product, they'd finance the project. But through time, our strategic relationship has evolved to something a little less. We're actually going to be buying feed from them. We're going to sourcing our own capital. And so as a company where we are as of just a few weeks ago, we'll be still working with Glencore, but we'll be buying from multiple mine sources, probably 2, and marketing the product our own and financing it ourselves. So we kind of come out from a big brother relationship to a strategic partnership that's going to allow us to be something a little more to our shareholders.
Okay, so talk to me about the ESG component here, because most people, when you talk about cobalt, they go DRC, verboten, no one wants it, right? And it's the same when you're talking about automotive manufacturers. They want to understand this complete supply chain, and they've got to sell that to their end buyers as well. So right now, DRC, you feel that you can work with them, like I know other people do, but it's not going to affect your business further down the line, or your ability to do business with them further down the line because it's coming from the DRC. That's not a problem.
Yeah, that's an important point. There are not many OEMs that won't deal with the DRC. It's what Mother Nature gave us, and that's where the product is coming. from. So BMW is the exception. They're going to take metal alloy, dissolve it, and make that into a sulfate for their batteries. It's more costly. Most of the OEMs have decided to, not much of a choice. We've got to accept the DRC as part of our supply chain. But then how do you deal with it from an ESG perspective? So there's two parts to the ESG mandate here. One, specific to the cobalt and the DRC is just responsible sourcing. And so artisanal mining is the trouble spot there, where you've got Chinese traders and buyers in country. You've got blending of material. How do you certify provenance of your material? So our answer to that is I worked at Barrick and like my team, we worked around the world. And, when you're a big company with a big operation, you carry the same standards anywhere you go. And so our solution is not to turn our backs on artisanal mining, but to at least recognize as a small company, we're not big enough to make the change at that level. It's happening. Our focus is going to be to buy from the big commercial operations. Ideally, this is the path we're firmly on right now. Buy from two of the biggest cobalt operations in the DRC. No intermediary, so you're going from mine site to our refinery, so that we can certify our refinery under the Responsible Minerals Initiative, which follows the OECD sourcing guidelines, and then we can warranty to our OEM customers that we will never embarrass them. Their brand will never be tainted by virtue of the product coming out of a refinery. So that's absolutely essential as a first point. And then the other part of the ESG is what everybody else is having to deal with in the world. What's your footprint? What is your environmental footprint? And on that, once again, we rank very, very favorably compared to the Chinese peers that would be benchmarked against.
Okay, I mean, it's a really important point, because of all the commodities, this is the one that seems to have been tainted most by issues around child labor, etc. But at the end of the day, do you think it's also a case of, well, we need to make money, and there's always going to be a buyer for it, so it doesn't really matter, does it?
Yeah, I think that we're all human. I'm a dad, right? I got an 8 and a 10-year-old kid. Amnesty International did a really good job, and Sky TV back in, I think it was 2017. And the campaign they ran was how much child labor is in your phone. And it put Apple and it put Samsung on the spot. Embarrassed industry, as it should, right? And I remember telling my daughter, I still get choked up telling my daughter, go into her class talking about mining and what mining can do. It's in the context of a children's rights discussion, children's rights in Canada, which is pretty different from children's rights in the DRC. But, children have different problems in different environments. And showing a movie of this boy, 7-year-old, she was 7 at the time, 7-year-old boy, a clip of him working in the mines or in the, sorting cobalt, carrying bags, and threatened to be beaten, and pausing the movie and telling her, like, did anybody catch his name? And a couple of people did. Anybody catch how old he was? They all got it, right? Same age as us. And I pointed to an empty desk. I said, that kid should be right there, not out there. And so, all this, not to get too emotional about it, but I do care. I do care about that. And I think the Glencores of the world do care about that as well. And so look at Tesla, Glencore, ERG, and others have formed artisanal mining initiatives, the Artisanal Mining Alliance being the biggest one, where we're going to try to empower, we're not a part of it, but just try to empower co-ops to go out and do this properly. Allow Congolese to be a part of their mineral extraction process, but in the right way, with reflective best and safety standards and major requirements and things of that nature. So I think people do care. But look, for the sake of money, there's always going to be the bad actors. And so for us, when you look at that supply chain, it comes to knowing where the minerals come from and keeping as few intermediaries as you can in between the mine head and the OEM as possible.
Okay, so you're 50 million market cap company. I mean, how much cash have you got?
We've got today we're sitting at about $4.5 million Canadian.
Right, and that's going to last how long?
It'll last us about a year's time without the CapEx that we're in the process of raising now for the refinery.
Right. Okay. So talk to me about what you think is happening in the marketplace, because we've seen Tesla Day and people talking about, we're going to take out cobalt, we're going to take out the nickel, we're going to, there's going to be lots of different battery designs and types for all sorts of use cases out there. So I suspect we're going to need all of the above. So I don't want to have the conversation about is cobalt going to be in batteries, but the demand side of things, you've got to have a view on that one, because you've got to make decisions about when you get this project up and running, when you go out for the financing for it, when you're going to need to raise some capital for your G&A, et cetera. Because you're right, it's been a tough 3.5 years. So what's your take on the market at the moment, realistically, honestly?
Yes, realistically, if you look at what could weigh on the cobalt market on a go forward. We do have, the battery chemistry, dominant battery chemistry is nickel, cobalt, manganese, NCM. And the trade-off has always been, look, we've got to get more nickel in there because nickel gives us the energy density. Nickel will therefore give us the range, but you need the cobalt for the integrity of the battery, just the stability, and that's heat propagation, fires, as well as the 10-year warranty. And so there is the trade-off, but we have as an industry successfully lowered the amount of cobalt. Now, it's not necessarily a bad thing because it makes the batteries more affordable and it gives you the range, it addresses range anxiety. Going to zero is a different animal. And so in China, the low-end batteries are the LFP, the lithium iron phosphate, and they're getting better as well. You're getting, instead of getting 80 kilometers, you're getting 200 kilometers of range. And so you're going to see more competition at the low end of the market with LFP batteries. We are thrifting, as I mentioned earlier. The NCMs are going to have less cobalt in them. But what's the flip side? Well, we got 5G. We got all the work from home devices that we're all buying. We got e-scooters and we got e-bikes. And then, of course, the big elephant in the room here, what's the penetration rate for EVs? So Glencore would tell you, I think like the annual report from a year ago, Ivan was saying, we're going to go from about 2% global penetration rate in 2020 to 10% in 2025. Well, that's a huge growth rate. Benchmark Minerals would tell you that if you look at, even with all that thrifting that I mentioned, LFPs and 811 cathodes, they still see EVs or batteries as a category increasing from 57% of total demand to 72% over the next 5 years. And so, the bull case has certainly been articulated. I'll let people draw their own conclusions. If you don't believe in cobalt, if you don't believe in EVs, you shouldn't be looking at First Cobalt. I think this is one of these mega trends, one of these generational shifts, and we're at the early days. Now, those of your listeners that are viewers who are in Europe will get it, right? Europe, I think at some point this summer with COVID, your sales were down, passenger sales down 25%, EVs were 2x. Now, there's a carrot and stick, right? There's incentives to buy the vehicles and the penalties for emissions and whatnot. But wow, nobody thought Europe would turn on as fast as it did this year.
Yeah, lots of incentives. There's going to be carbon taxes. There's all sorts of drivers from governments and support from government, for sure, not just Europe, but China, US too. We are seeing that. But how does a small company like you survive to take advantage of it? Because you say you've got a refinery. It's a small refinery. Is it big enough? You've done some M&A, so you've got the capability and expertise to do that. What else are you going to need to do to be meaningful?
Yeah, so what you're going to see from us with this change in commercial construct with Glencore over the coming weeks, hoping to lock up 2 feed contracts. So I want to show the market that we're going to be able to fill this refinery up. We've got a financing process that's been on hold while we're waiting for the commercial contracts to come to fruition. No longer Glencore-led financing, which is a testament, I think, to the interest. We're talking to private equity firms, but also a couple of big international banks. So people do want to get behind this. This could be a green loan. It's a sustainable investment, et cetera, et cetera. So we've got 4, maybe 5 parties that are kind of in a second round financing. So line up the financing is next. Offtake, people want to see that big offtake contract or 2 with the OEMs. That'll come. Now, what that's going to look like in, I would say, 18 months from now, when we plan to commission, is a plant that goes from nominal today 12 ton a day throughput to 55, yielding 5,000 tons of cobalt units per annum. So you're talking 4 or 5% of the total market and the only North American supply. So our cash flow, our annual cash flow pre-tax is equivalent, that's projected, is equivalent to our current market cap. And so we haven't even talked about our mineral exploration assets and what kind of multiple you put on the cash flows. So we're getting there. We're on our way, and I think investors that have been following us have been waiting for news for many months. I would say we're on the cusp of some big announcements here, end of Q4 and into Q1, that will really paint the picture of how we're going to move forward. My goal, just to articulate it, Matthew, would be to let's get the feed contracts done in Q4. Let's get a handle on this financing. I don't know what that looks like, but announce something on the financing side of Q1, and let's move to a construction decision here. It's not a decision. Commencement of construction in June. And we're projecting roughly a 12-month construction timeline. Maybe it's a little longer before we can commission. So it's a pretty compressed timeline here to get ourselves where we want to go.
Right, it's interesting. So I'm not quite sure if it's horse before the cart or how do the contracts come first, or do the financing discussions happen first? You can't do one without the other, it seems. Difficult.
Yeah, when you look at how we're going to tie it all together, is we do have a metals trader, a couple of firms we're talking to, that are going to provide that backstop that our lenders need. And so we'll have our feed contracts together soon. We've got the lenders. But the OEM, those offtake contracts are going to take a little bit longer. And so in order to move the financing forward, I'll have a trader standing by saying, look, we'll take 100% of all the product pending placement under OEM and long-term arrangements so that we can get the financing locked in and move ahead with that construction.
When you do get that under your belt and out of the way, the exploration component, because you're talking about, 100 plus historic silver cobalt mines in the Canadian cobalt camp. What does that mean? I mean, you've got 100%. Do you own some of that, all of it? What's the opportunity?
Yeah, I mean, our count, and it's hard because this was 1904, building a railway, vein propagated at surface, and all of a sudden it was like a Klondike gold rush. We had 10,000 prospectors. And through time, so 1904 through almost 60s, but a couple of them went to the 80s, you had about 104 different mining operations. Some of these were meaningful. Nico Eagle got their start there. Teck had a big underground mine there. Some of them were smaller. It would have been you and I in a pickaxe, right, following a vein and getting native silver out of the ground. So through time, this cobalt embayment up in Ontario, in one of the Canadian provinces, it mined 600 million ounces of silver and 50 million pounds of cobalt as a byproduct, and often not necessarily a desirable one. It was an indicator mineral, trace mineral to know that, okay, we're in the right area. Where we are now, we drilled that fairly extensively in 1718, 12 different targets, 30,000 meters, $10 million. The first modern geoscience applied to the area. So I would say we fell short on our goal of let's find a big open pit. What we did find, though, is a reinterpretation of the geology. We've got, to answer your question directly, we own 50 of the 104 past producing mines. We've got a lot of high grade targets. And what's happened, though, of course, is, cobalt's half the price it was. Silver is double the price it was when we were drilling it. So guess what? We got a lot of silver players knocking on our door looking to buy it, partner with us. And given that it's third rung, I guess, in our suite of assets, it's refinery, and then it's Iron Creek, Idaho, and then it's the Ontario play. You might see us look to monetize some of this if we can either, raise some capital for the refinery or go along for the ride on an earn-in and ride the coattails of a silver miner. Silver is, it's high grade vein style mineralization. You got to be very diligent, very judicious. We were going at it with a different approach. As we go back at it, sort of round two, we announced in geophysics today, you do have to follow the structures more closely if you're going to follow up on that style of mineralization. So you'll have some news. I think it's going to be at least as much silver news as there will cobalt, though, in Ontario.
That's very topical. Why not? What do you know about that? Because that's a big chunk of change. You mentioned $30 million spent, right? Plus whatever the previous owners spent. So it must be a lot of data.
Yeah. Sorry, 30. Maybe I got it wrong. $10 million to spend, 30,000 meters of drilling. So
sorry,
I did get that wrong.
It would probably more likely me. Okay. So, but there's still the question stays the same. That still sounds like a lot of information.
It is. Yeah. I mean, Nico Eagle is still they're the next sort of biggest partner, but it's a reclamation play for them, right? They're holding costs. There has been no modern geoscience. So the geophysics, the mapping, the sampling, understanding structure, there was a lot of assembly of information, mapping old adits, known veins, and then overlaying that with some modern work, including, of course, ultimately you got to drill it. And so we've got probably the only we do know the only digitized database of a very prospective silver cobalt district. Again, we hopped over to Idaho because we were hitting everything was cobalt. I think we've got a deposit model here that is going to inform us. We're going to do a little geophysics now to follow up on the mined areas up in the northern part of the camp, an area we call Kerr Lake. And based on that, I think the opportunity in this camp, I mean, it's 100 square kilometers. The northern and southern extents of the cobalt camp were mined because, of course, you had veins propagating to surface. Back in the early 1900s, anything under cover basically went unmined, and that's the central part of the camp. So with the knowledge that we have acquired over our first sort of year and a bit of exploration, the idea is to apply those tools to see if we can get the blind discoveries. And instead of looking for 10 million ounce deposits, let's look for 50 million ounces. I got no basis to say that, but that's kind of the order of magnitude of the prize, if you will, that we'll be looking for as we go to the central camp that has that overburden.
Okay, so if I listen to some of the commentary from your existing shareholders, they're I think with all investors, you're going to the moon, so that's good news. But I'm kind of keen to understand for new investors looking in at this thing. Obviously, cobalt price is doing what it is. There needs to be some price discovery. I get that, and you've explained, your primary focus being, obviously Idaho and the refinery. But with these assets, you talked about the possibility of bringing in partners or doing farm outs for these. Farm outs themselves don't tend to bring a lot of cash in day one, but there may be something. So what would you hope to be able to bring in the near term in terms of some cash contribution? Obviously, retaining some carry would be brilliant, but what's the near term upside for you guys when cash is tight?
That's a great question. So cash is tight, and I don't want to dilute right now, and yet I do feel quite confident that we can pull off our $60 million financing, big 60 US, for the CapEx in the coming months. But that's still a few months away. We got to get our FEED contracts done and winnow down the lenders to one and do the site diligence. So in the meantime, we could be doing a lot of work. There's more met work I'd like to do. There's some detailed engineering. There's some procurement activities. So in order to do that, if I could, it's not much, right? $1 million, $2 million, $3 million would go a long way to de-risking the project and to shortening that timeline. To your point, though, the carry is not insignificant, right? Because right now we own 100% of something that I get zero value for. So if I can bring in a partner and they can push the asset forward because it is third run, then I'll have whatever, 50, 40, 30% of something that has some real value, depending on how we structure this. So it's a bit of both. We're not going to give it away. I would say I'm a motivated seller, but not a desperate seller, because the holding costs here are nil given all the work we've done.
Yeah, true. You can't bring in Chinese money, can you?
Nope. No, absolutely not. And in fact, I got to say, the government has been a great partner of ours. That's a bit of a segue, but with what we're doing, it's a critical mineral. There's a lot of cooperation between the U.S. and a lot of its allies to find a domestic source of cobalt. We're right there. I got the former governor of Idaho on our board. I've been talking to them about supporting our project. They put the two levels of government, provincial, federal, put $500 million into Ford about a month ago to help them electrify their Canadian operations. And the idea was that we got to link our assembly plants to our Canadian mines. Well, there's a whole midstream there, of which I'm a part of, that needs to tie into that. So I've been working closely with the government. I know what their thinking is. China money probably wouldn't be advisable.
Not going to fly. It's not going to fly. And you're pretty close to that kind of automotive hub. It's a little bit further south of your assets for sure. And talk to me about the corporate structure, because again, the difficulty for junior miners going over a period, of years when the markets are not working in their favor, it means the corporate structure gets a little bit untidy. So where are you at today?
Yeah, if I want to talk specifically about the capital structure, one of our companies that we merged with was Australian. And so those of you who invest in Aussie companies know that Aussie juniors are accustomed to having hundreds of millions of shares out or 1 billion shares. That doesn't fly with U.S. institutions. And so after, 4 mergers, we're sitting at 400 million shares. Unacceptable to a U.S. institution. And so that's on the horizon. I've looked at, 3 dozen share consolidations, and you'll know this. You never do that from a position of weakness. But if you can do a roll-up, do a share consolidation on strength, on an OEM partnership, on a financing, construction announcement, you can ride that momentum and clean things up. So I would say stay tuned. That's something I hope to address in the first half of next year. But again, as a shareholder, I'm not going to do that flippantly or recklessly. We'll do that when the time is right. And then when we talk about corporate structure, if you want to talk about people, that's been an interesting evolution as well. At inception, we were heavily geologically focused. We had a team, probably 12 employees, geology, and we had 40 some contractors between 2 properties. That went down to 1 in 2019 when things got quiet, and it's harsh, but that's we all know that's the nature of the business. And now we're starting to build up on the other side, and it's not necessarily full-time employees. We got Mark Trevisiel, who ran the Glencore smelter, is going to build the project for us, a good process guy. And we're calling on people, contract basis and whatnot. But if you got people that have operated, where the good bodies are. And we'll build a proper corporate team through time. But again, the resources are scarce. And we sort of stitch these things together. We went, again, from probably 50 employees in the heyday down to 7. We might be sitting at 8.5 or 9 today. And that's enough, right? We rely on our consultants. And when I have the resolve, actually not even the resolve, when I have the money in the bank to do the expansion, then we'll build out a proper corporate team. Until then, this works, and this is this will have to do.
Yeah, how many other boards do you sit on?
I sit on a charity board, and I just joined the board of Toronto Hydro. So I'm pretty focused on what I'm doing. The Toronto Hydro board, there's a lot of parallels with what I'm seeing and what they're seeing. And so I thought as an electricity distributor, their world is changing, and they thought that I could maybe play a role with their strategy.
Great. And have you picked up many shares over the last 3.5 years yourself? I mean, I don't mean the cheap stuff at the beginning. I mean at market stuff.
Yes, I have. I've been buying through it. I buy it up, I buy it down. I'm consistently in the market. If not every quarter, then certainly each half I've been in the market. And I do want to, I take pride, maybe some solace. I never did get the cheap shares, right? I came in after the company was formed. So my first year in the company, I took my salary and invested alongside my shareholders at 50 cents. We're sitting at 14 today, and I've been buying ever since. So, I don't know, a couple of million shares that I own today. I'm not a Ross Beatty, not independently wealthy. What I have is meaningful to me, and I plan to keep building on that.
Okay. Is there are there many of the cheap stock holders left in the business, or have they all exited? I
believe they are all long gone into cannabis and blockchain and God knows. Hey, look, and they, what I will say, and this has been an eye opener, because I don't come from that world. When you do these companies, these promotes, often falls flat, right? The cheap seats are vacated, and everybody else is left holding the bag. There are a couple of stories. My sister company, formed by the same group, Standard Lithium, and soon to be First Cobalt. Maybe you break the mold, right? Maybe if you bring the right management team in, you time it right, you get some assets, then the people that are left, put a quote unquote, hold the bag, actually do get rewarded. And I take a lot of pride in, we had an interesting start to life with, promoters getting the cheap stock, but I'm looking ahead, not that long, 6 months, 12 months, 18 months. And I think people that have stuck it out through some tough times will be rewarded.
I think we've got Standard Lithium coming on later this week, if not the beginning of next. Yeah. How are they doing?
Yeah, great.
Are they doing a good job?
I'm a big fan of Robert. They're doing a very good job. Yeah, Mintex, he's a good CEO. Cerebral type. I'd like to think I am, maybe not as much as him, but just very focused, right? Not scattered. You could look at First Cobalt and say you have been scattered, but I think we've been nimble. I'd like to put it that way. And we've done, one asset at a time. We're not chasing three things, even though we got three. But you have to be in this business. And to me, it's how do I surface value? And now it's how do I get to cash flow? And everything I can do to get us to cash flow has got to be priority.
Right. And with the refinery, it's with a 60 million CapEx, that for a $50 million market cap company, that's a tough ask. How do you do it?
Yeah, the plan here, if and that's 60 million US and 50 million Canadian or so.
Oh boy! Yes, you're right.
The government, governments I think will be there for us. I think we're going to get some support on that level. This is going to be mostly debt. Our cash flows, take your commodity price and all your assumptions. Our feasibility study would say 40 million pre-cash tax flow. You can stress test that, get that down to 22 at spot prices. Nonetheless, there's a pretty good payback on the US dollar cash flows, so we don't mix up our currencies. There's a pretty big payback, pretty quick payback. So, I got to look at servicing the debt. I got to look at the downside scenarios. I got a great CFO. I wouldn't anticipate raising more than maybe 10 million of the 60 in equity. But again, that's the last leg of the stool. Once you've underpinned the story and hopefully got a bit of a re-rate. So debt focused, 5-year term. And you link your supply contracts and your offtake with a trader in the background to backstop any excess supply. There's going to be a very straightforward yet complex web of partners behind the scenes to ensure that our revenues and our debt service payments are well aligned. Okay,
but the feasibility study, the numbers look good. You think that has you walking into conversations with some degree of confidence, does it?
It does. Two things. One is the execution risk. The flow sheet is very straightforward. So we've had a team of Glencore technical folks, Murrin operators, Glencore technology. So it's a global team working with Asenco and SGS and our own group. Everybody agrees this is a pretty straightforward flow sheet, and the feedstock is well known, right? This is not a new mine with new feedstock and an unknown head grade, and we're re-permitting, or I guess we're amending permits to an existing facility. So. That's all. I think that's all fairly straightforward. So the execution risk for us really has to do with the management team, building it right and making sure that that you negotiate smart commercial contracts. So the devil might be in those details. And if I look at sort of the margin opportunities, again, you've got price discovery for cobalt it's not LME, it's fast market, so it's subscription based, but price discovery can be done at a low cost. So, we're not going to be caught with our pants down too much insofar as we know what the market basis is for feed purchases and for offtake.
Okay, brilliant. Well, look, thanks for that run through. It means, like I say, it's the first time I've heard the story. Appreciate your candor. And stay in touch. Pick up the phone. Let us know when there's something to say. We'd be delighted to take that phone call.
Okay, yeah, I'd love to. It's going to be hopefully pretty soon.